We have finally did it. Welcome back, IB Economics students, to this final IB Microeconomics review on every single topic you would need to know in order to be prepared for the upcoming IB Economics test. Okay, so I will be going over both SL and both HL topics that you need to be able to know. There's a ton of content we have to get into, so I'm just going to start going into it. Okay, the first unit you're going to be going through is competitive markets, demand and supply, which is the first subtopic you need to be able to know is the nature of the market. Okay, so outline some terminology. For example, production possibility frontier. For example, you need to be able to understand scarcity, marginal utility. Okay, these are some characteristics of the market you have to understand. So that's the first topic. The second topic is the law of demand. Okay, you need to understand the inverse relationship between price and and quantity demanded. You have to describe the relationship between a price of a good and a demand and a quantity demanded for a good. The demand curve, you need to be able to understand not only the law of demand, but also be able to understand and draw out the demand curve. Okay, understanding that, you have to be able to understand the determinants of demand. What causes people to change their demand for a certain good? What are some factors that change? Is it price? Is it advertisement? Is it the functionality of a good? What changes? Okay, is it time? Okay, is it the accessibility of the goods? So what causes? Okay, what change causes the demand for the goods to change? Okay. The next topic you need able to understand is the movement along the shifts in the demand curve. Okay, when there is a change in advertisement, how does the demand for the good change? When there is a change in price, how does the demand for the good change? Okay, and you need to be able to understand that. You also need to be number to understand and distinguish between quantity demanded, change in quantity demanded, as well as the change in the demand curve. And also, very importantly, you need to be able to illustrate the differences, okay, that it has between the two, and also be able to illustrate changes in demand and the changes in the demand curve. Now, for HL students only, you need to be able to know linear demand functions. Okay, you need to be able to calculate using the y equals mx plus b function in order to calculate the linear for the demand curve. Okay, so this is for the demand, and for the supply side, okay, the supply is basically exactly the same. For example, you need to be able to understand the law of supply. You need to be able to draw the law of supply. You need to understand the law of supply, and discuss the positive causal relationship between the price and the quantity supplied. Okay, so this is the law of supply. You have to be able to understand the law of supply and be able to go back and to draw the law of supply and to describe why producers would like to produce more as price increases, and why producers would like to produce less as the price decreases, because they allocate the resources to more productive sectors of their firm in order to profit maximize. Be able to understand the supply curve and why it is upwards sloping. You can be able to understand and illustrate in graphic form why at higher prices firms are more willing and more able to sell more of the goods. So the supply curve, you have to be able to understand why the supply curve shifts upwards, and as well as how to draw the supply curve. Non-price determinants of supply. Be able to understand and talk about, in addition to the price, what else changes in order for a firm to produce more of a good? Is it because rival firms are producing less of the good? Is it because rival firms are producing more of the good? Okay, what changes? Why does firms produce more or less of a good? Okay, you have to be able to describe that. Some common non-price determinants of the supply. Equilibrium changes, okay? Whether there is a change in supply, increase in supply, or decrease in supply, increase in demand or decrease in demand. These are all going to lead to equilibriums and changes in the equilibriums. So you must be able to illustrate changes in equilibriums and the effects on the price and the effects on the quantity these changes on equilibrium has on a specific market segment. Movement along the shift of the supply curve, okay? Increases in price. What does that mean for the quantity supply? Increases in quantity supply. What does that mean for the prices? Okay. For HL students only, you have to be able to draw and able to graph and calculate linear supply equations on the graph. Okay. Equilibrium and changes to equilibrium, it's quite standard stuff. You have to be able to calculate the equilibrium or using the linear equations if you're an HL student. For SL students, you must be at least able to you need to at least be able to determine what is the equilibrium and at which quantities market equilibrium is reached, free market equilibrium is reached. Okay. For HL students only, you also have to be able to calculate and illustrate equilibrium using linear equations. That's what we have also talked about. Resource allocations talk about at which points there will be optimal resource allocation. Of course, that will be at the point of equilibrium. Okay, understand the idea of scarcity and implement it into resource allocations. Now, under resource allocations, when there is misallocations, there will be consumer surplus. Okay, anywhere above the free market equilibrium line will have consumer surplus. Anywhere below the free market equilibrium price horizontal line will have producer surplus. And allocative efficiency is usually met when a market equilibrium is reached. Okay, so good things good. This is the first unit that you may be able to understand of comparative markets. I have made a video for every single one of the topics in this chapter, chapter 1.1. If there is any questions at all, please refer to the playlist link to this video below. Unit 1.2 is actually quite a heavy chapter, and it is about elasticities. Now, elasticities very simply measures the changes in a variable when another variable changes. Now, the first elasticity we are going to learn is the PED, okay? Price elasticity of demand. You must be able to understand what price elasticity of demand is, what the determinant for price elasticity of demand is. You must be able to calculate price elasticity of demand using changes in price as well as changes in quantity demanded. You must know how to calculate that. You must also state what the PED value means when it is negative, when it is or when it is positive. You must also be able to understand the applications of price elasticity of demand. That's another subtopic. Okay, what is the role of PED when it comes to taxation? What is the role of PED for producers or firms looking to increase the price for their good? What is the role of PED for consumers even looking to buy a good? Okay, you must be able to talk about the applications of price elasticity of demand. You must be able to talk about why price elasticity is important for consumers and what is important for producers and governments. It is important for governments because they are looking for goods that have low PED in order to levy higher taxes on. For example, on cigarettes or alcohol goods, they have lower PEDs because of the addictive nature of these demerit goods, leading to higher taxation. So another very important topic you have to understand, the next topic, the next elasticity is XED, okay, cross price elasticity of demand. You have to be able to calculate it. You have to be able to talk about the applications of it. You have to be able to talk about the relationship between complementary goods and substitute goods. You have to be able to talk about the closeness and how close these two complementary or substitute goods are. You must be also able to talk about the absolute value of the goods because the coefficient is always positive or is always negative. Okay. Talking about the next elasticity is income elasticity of demand, which is YED. We use YED instead of IED because I is used as investment in macroeconomics. That's just a trivia. Trivia is not really important, but it's good to know. You must be able to, once again, calculate it, talk about the factors behind it. You must be able to talk about three different goods: luxury goods, normal goods, and subnormal goods. Okay, so you have to be able to talk about these three things, and then talk about the relationship and the correlation between the luxury goods, normal goods, and subnormal goods, and relationship and correlation with income elasticity of demand, as well as calculating and talking about what the absolute value of income elasticity of demand means. In addition to knowing that, you have to be able to do calculations on it, as well as applications for YED when it comes to the field. Now, if you have any questions at all about these, I have a playlist linked below on every single video that I have made upon microeconomics. Okay, my playlist of around 50 to 60ish videos goes into every single topic, every single subtopic you would need to know for microeconomics. Okay, our next topic, our last topic is price elasticity of supply, PES. You have to once again be able to calculate it, talk about the correlation, talk about why the determinants of PES, why firms produce more when price increases, produces allocative allocative efficiency, as well as be able to explain the applications of PES. Okay. Topic 1.3, government intervention, includes basically four-ish main topics. It is not a heavy topic at all. So our topic 1.3, government intervention. So government intervention, we have, of course, taxations, we have subsidies, we have price floors and price ceilings. Those are basically the three government interventions you have to be able to understand. So under taxations, we have two major taxations that we have to learn about. The first, excuse me. The first is specific taxes, okay? Specific taxes are just a direct tax, okay? It is a form of direct tax. For example, a pack of cigarettes, we all have $2 specific tax on it. That is a specific tax. And our volume tax, on the other hand, is an percentage tax, okay? In the cigarette example, instead of having $2 in addition to what is originally charged, we're going to have a percentage, let's say a 20% tax on the good. And you have to be able to understand this, differentiate between a specific tax and ad volume tax within the indirect tax brackets, as well as be able to understand and the graphing behind it, and be able to graph specific tax and ad volume tax behind it, okay? For IHL students only, you also have to be able to talk about the importance of PED, as well as other elasticities. You have to be able to talk about the correlation between elasticities and the taxation levy. Okay, that's not too hard. You also have to be able to use graphs and diagrams. It shouldn't be that hard because, governments look at the PED of a good, and if the PED is relatively inelastic, governments would opt to actually impose taxes on it in order to maximize profits and not harm producers as much. Okay. Impacts on the market when taxes are levied. You have to be able to talk about how the supply curve either shifts to the left to a great extent or to a little extent when either specific or odd volume taxes are imposed. That is because prices of a good increases, leading to a decrease in the consumption of a price. Be able to plot and talk about the elasticity and shifts in the supply curve when taxes are levied on a specific market supply. Okay. Price ceilings are maximum prices legally able to be sold at, and price floors are minimum prices. So price floors are always set, okay? Price floors are always set above the market equilibrium, and price ceilings are always set below the market equilibrium. So this is a little bit of a tricky topic that some students actually kind of struggle with in understanding. So you have to be able to understand this and do not make that silly mistakes. A lot of IB economics students make that very, very silly mistake of putting the tax ceiling above the free market equilibrium part, when in reality it should be below the free market equilibrium. Okay, so price ceilings, you must be able to understand that. Price floors, minimum prices is above. And understand the welfare loss, okay? The loss in the allocative inefficiency that occurs when price floors are actually set because the market is not producing or consuming at its optimum quantity and price produced. Okay, so that chapter 1.3 is actually quite a light unit. You shouldn't be having too many struggles with it as long as you understand the topics and is able to graph the taxes, the subsidies, as well as price floors and ceilings. So chapter 1 to 13 is not that hard. 1.3 is not that hard. Let's move on. 1.4 is market failure. Market failure is also not that hard. So define market failure. Market failure is when there are allocative inefficiency in the market leading to a market failure. So market failure as a topic shouldn't be that hard. You also be able to understand the meaning of externalities, whether positive or negative, and the implications of externalities on producers when the marginal social benefit is greater or lesser than the marginal private benefit, and correlations when market failure does not exist. The marginal social benefit is equal to the marginal private benefit. So the meaning of negative externalities and positive externalities in correlation with market failure, you must also be able to understand this. So negative externalities of production and consumption. positive externalities of production or consumption, be able to understand these, use diagrams and graphs to explain and to give examples of both of these in correlation with market failure. Shouldn't be that hard to understand. The lack of public goods. Okay, once again, public goods have two primary characteristics. They are non-rivalry and they're non-excludable. These are quite weird characteristics for a good to have. And of course, you have to be able to just to talk about and know the difference between a public good and a quasi-public good. Okay, for example, in some countries, public goods are roads are not public goods. For example, in Singapore, the car taxes are so high that the car taxes alone pay for the roads. So the roads, although being non-rivalrous and non-excludable, are actually not public goods. So you must be able to talk about the lack of public goods and why. You get the free rider effect. You have to be able to understand the free rider effect and how the free rider effect is causes public goods to suffer and undersupply of public goods leading to a market failure, where allocative inefficiencies within the free market lead to a market failure, where the undersupply of public goods lead to allocative inefficiencies. So common access resources and the tragedy of the commons, once again, not quite an easy topic. You must be able to understand also under a market failure when people act in their own self-interest and rather in the self-interest, or rather than in the interest of the collective society. That is when the tragedy of the commons occurs. Common access and development, sustainable development, when it comes to pricing mechanisms, when it comes to economic development. Okay, asymmetrical information, information failure and abuse of monopoly power, price gouging, jacking up prices, legal monopolies are all prime examples of abuse of monopoly power. Asymmetric information, for example, when advertisement is used and abused to such a great extent that people actually find a good to be more superior based upon incorrect or flawed information, that is also leading to a market failure. Okay, so theory of the firm is actually quite a heavy topic, quite a heavy unit within the microeconomics section. It is almost exclusively HL only, so it is actually a very hard topic for a lot of people to understand. But I do hope that my videos in previous sections going over theory of the firm, going over each and every one of the market characteristics was helpful. So if there's any questions, you can be sure to just be free and go down to the link below, where I will be linking a playlist of the very important topics and concepts you have to be able to understand. So under theory of the firm, the first thing you have to be able to understand is the law of diminishing returns. Okay, distinguishing between short run and long run in the context of production, be able to distinguish between the total product, average product, and marginal product, and be able to construct diagrams now which shows the relationship and correlation between all of these different productions. Okay, and the law, how the law of diminishing return. Okay, the law of diminishing returns basically states increasing a variable amount of factor will increase the production outlet to a certain extent, where constant returns will occur, and then diminishing returns will occur, where actually productivity or output will decrease as additional variable factors are increased. Okay, also be able to calculate the total or average and marginal products from a set data or diagram. Okay. So the next subtopic you have to be able to understand is cost of production and economic cost. You have to be able to understand and explain the meaning of economic costs in relation to not only economic cost but also opportunity cost. I gave the example of how accountants look at only economic cost, but economists look at also opportunity cost. So you have to be able to talk about the theory of opportunity cost and the theory of economic in relation with the theory of economic cost. Distinguish between explicit and implicit costs. The difference between explicit costs and implicit costs, of course, boils down to the idea of economic cost versus intrinsic or opportunity costs. Of course, accountants and economists have a different a viewpoint on cost and cost theory. We have a video on cost theory now, which dives into the different types of costs and the costs that are examined by different groups of people. So that is a sub point you also have to be able to understand. cost of production in the short run and cost of production in the long run. You have to be able to talk about all the different, the average variable cost, the average total cost, the average cost, the marginal cost. You have to be able to explain and distinguish between short run and long run cost with reference to fixed factors, because in the short run, at least one factor is fixed. In the long run, all factors are variable. That's where we get the bullshit, okay? The law of diminishing returns, the law of diminishing return kicks in when long run costs are considered. Long run costs, including both explicit, implicit, economic, and opportunity costs, are considered within the diagrams presented. So also be able to explain between relationship of production curves, whether it is average product, marginal cost, variable cost. You have to be able to look at the relationship between these costs and productions and put them all together. Okay, production in the long run returns to scale. Or economies of scale, where increasing the production factors and increasing the production size would increase the production output on an increasing marginal quantity to a certain point, which is what we call the tip over point, where we have constant returns to scale and then diminishing returns to scale. Also be able to understand within this section the differentiating factors between internal economies of scale and external economies of scale. So internal economies of scale is basically economies of scale that occurs within the company and the corporation. External economies of scale are economies of scale that occurs outside of the corporation and outside of outside of the firm, within the industry as a whole. We have gone into a lot more depth in previous videos, so we are just reviewing total revenue, average revenue. So average revenue, the correlation between revenue and profit is actually really clear, but revenue is equal to profit is equal to revenue minus expenses. So just be able to understand that and be able to distinguish between total revenue, average revenue, and marginal revenue. Use diagrams to illustrate and calculate a total revenue, average revenue, and what it looks like on a graph. Okay, economic profit, talk about what economic profit is. We'll talk about supernormal profit, subnormal profit, and break-even point, and the correlation between the marginal cost, the average total cost, and why these three lines are related, and how the position of the average total cost curve within the market diagram would show whether it is having supernormal profits, normal profits, or subnormal profits. Okay, so it's very important. A supernormal profits, for some people, would call it abnormal profits. Not that big of a deal. Just they're basically synonyms. So they're interchangeable. So also be able to talk about profit maximization and why the quantity and price of profit maximization is met when marginal revenue equals marginal cost. That is because of we made a video on that, but profit maximization, be able to know the profit maximization point and why profit maximization is reached when marginal revenue equals marginal cost. Alternative goals of the firm, in addition to profit maximization, maybe charity, it may be revenue maximization, it may be growth maximization. Be able to talk about alternative goals of the firm, be able to talk about the different goals and objectives of a firm, in addition to profit maximization and assumptions to the model. Okay. Also, in addition to knowing the revenue theory, also be able to draw revenue curves and profit maximization in the short run, profit maximization in the long run. Be able to also understand the shutdown price and break-even prices in relationship with the average total cost. Be distinguished between the short run shutdown price and the break-even price. Explain also using diagrams when a loss and when a financial loss occurs with a firm, and whether a firm should shut down or should continue hustling by. Also understand the barriers of entry and what the barriers of entry imply for a free market firm, either in monopolistic competition or a perfect competition. Within the syllabus of theory of the firm, we're going to be going over 4 major market structures. Okay, monopolies, oligopolies, monopolistic competition, and perfect competition. So the first one we want to be talking about is monopoly. Okay, we have to be able to talk about the assumptions of a monopolistic diagram. We also have to talk about what it looks like, what a monopoly looks like, and why there are long-term supernormal profits in relation to monopolies, and why monopolies make long-term supernormal profits because of the lack of barriers to entry. And I'll be able to describe using examples, barriers of entry, whether it is legal, whether it's economies of scale, including economies of scale of barriers of entry. I'll be able to talk about the revenue curves of monopolies, be able to talk about why monopolies have long-term supernormal profits. Under profit maximization, also be able to talk about the short run and the long run for each of the monopolies. Profit maximization in the long run and why there is long-term supernormal profits for monopolies. Non-price competition, also talk about competition between firms that are not just related to price. It could be advertisement, it could be endorsements, it could be anything, or acquisitions. These all fall under non-price competition of strategies a firm may take. Monopolistic competition is the second market structure we have to be able to talk about. We have to be able to draw the graphs and be able to talk about why there is no long-term supernormal profits. You have to be able to understand the characteristics, understand the diagram, and know how to draw it, okay? Assumptions of the oligopolistic market, we have to be able to understand the kink demand curve. We have to understand the characteristics as well, what it looks like. Game theory, we have to understand why firms would not increase prices when competitive firms increase prices, and why firms would decrease prices when competitive firms decrease prices. That's the idea of game theory. We have to also be able to talk about tactics and relationships between collusive and non-collusive oligopolies, and why collusive oligopolies functions as a monopoly. We also have to be able to talk about the necessities and conditions for price discrimination to occur and what price discrimination looks like. So these are all the topics you have to be able to understand and you have to be able to talk about when you do IB Microeconomics. So I hope this video is helpful in going over every single topic. You have to be able to understand if this video is helpful. And if you have any more questions, be sure to leave it in the comments. And if you have questions concerning, so this is an article. I'll also link it below. Okay, I'll also link it below. If you also have questions concerning any of the topics, go to the playlist linked below. We have a lot of different. We have all of these topics covered in previous videos. I hope this video is helpful, and our next syllabus, our next topic is going to be going over macroeconomics. So I hope this video is helpful, and I hope these video playlists are helpful. If it is, subscribe, and I hope to see you guys in the next chapters. Without further ado, good luck, get that 7,